Hi everyone, thanks for checking out my first video on the new channel. Hopefully you will find some informative stuff. I know that if I had known this information several years ago when I started investing, it would have helped me out greatly. So that's why I'm going to convey what I've learned to you. So essentially the reason, or one of the main reasons I decided to switch away from UBS to Schwab is UBS was my brokerage for several years, and they charge an annual wealth managed percentage fee, I think taken out quarterly, and really it was crazy to me because no cash. They even had to sell shares of my own to pay their own quarterly maintenance advisory fee. So specifically, what I'm going to be discussing or going into detail about is why I chose UBS in the first place, more in depth about why I needed to transfer away from it, and why I chose Schwab specifically. So, once you start working a job, big person job, and have a few extra dollars to invest, the default way, or kind of the classic way of thinking about investing, is seeking out someone who knows what they're doing, paying them to help manage and advise you manage the account. The assumption there is, and you wouldn't have done this if you didn't assume this, is that they know how to invest, they know what to invest in, they know when to invest it and when to sell, and how to adjust your portfolio overall, especially in times of market peril. So specifically choosing UBS for me was I had some family members who went through a local UBS group. They had done so for decades, and so naturally that's what I went with. Now, one thing to keep in mind is that these wealth managers, just picture it, a job wouldn't exist if people weren't paying into it for that job to exist. So these wealth managers would not be there if they weren't raking money from your investments and putting them in their own pockets. Now, to kind of lay cover and help justify themselves, they'll act warm, they'll act responsive, they'll bring you in for portfolio reviews. They may even send you cards and even gifts, flowers, poinsettias around the holidays. They just seem like they're professionals. They have the special skills that you don't have, so paying them is worth it. But again, that 1% annual fee to me was not worth it the more I looked into it. What they won't tell you is that that fee in itself, plus any other fees, are the biggest impediment to your long-term growth. So their mere existence is preventing you from having this good growth. So to make my case even worse is the mutual funds that UBS had me invested in weren't even that great. They had high expense ratio fees embedded in the funds. Expense ratio fees are kind of the fee that is universally, you kind of have to accept it. So you have to go with very low expense ratio fees, even though we have now things like Fidelity Zero. So the trend is moving away from the expense ratio, even the expense ratio fee. But UBS had me invested in mutual funds that charged what I would consider high investment or expense ratio fees. And everything fell within, and kind of the limiting factor for UBS is they were buying things that everything fell within this quote-unquote PACE qualification. So all the fund names had PACE in it. It had to stick to, for whatever reason, that rule. And obviously when you're limiting yourself in that regard, you're not opening up yourself to the full possibilities of investments in the market. So kind of compare and contrast, I had a separate Roth IRA with a separate wealth manager which looking into that account now, I would realize that's closer to what I would invest in than what UBS had me invested in. And that Roth IRA that was not invested through UBS has exponentially larger growth. In fact, two of the 7 mutual funds UBS has me invested in have lost money, even in this crazy good market, everything's doing so well. They had me invested in 2 funds that have lost money. So obviously I knew I had to get out. Now, you'll see all through online advertisements and so on, once you start looking into this, some of the common names that are going to come up to move your money or start investing in are going to be Fidelity, Schwab, Ally, maybe E-Trade. Now, the differences among these aren't going to be too major. So even though you're going to research and you're going to realize what the differences are, don't fret over too much as long as they're avoiding charging you these maintenance, advisory fees, etc., just to have your investments in with them. So specifically why I went with Schwab, and some perks there are I got 100 free trades just for transferring my money over. I think the more money you put in with them, the more that'll go up. I think the next benchmark is 500. Just as a customer service, they gave me gratis another 100 free trades, so 200 total. You do have a time limit. One of those 100 is going to be a year, the next 100 2 years, so they will go away. But by then, because I'm going to have basically passive investment, or going to passively manage this fund, and once I get it adjusted to where I want it to be, I don't expect to be doing too much buying and selling after the 2-year point. So another perk of Schwab is that they covered the 2 $95 transfer fees, one for each account that UBS charged me. Their phone customer service is, I would say, in today's phone customer service, everyone knows how poor it is among so many companies. But for whatever reason, and Schwab is the best I have encountered, and that's probably no accident. So that is a great perk of going through Schwab. And another perk is that there's a specific index fund within Schwab that I like, and they will never charge, or at least the practice is now that they don't charge to buy and sell index funds within their own brokerage of their own index funds. So, if there's a Fidelity fund you like, there will be no charge if you're invested through Fidelity to buy and sell their own funds. Now, one thing I do want to note separately, I use Robinhood, the Robinhood app, for some other investing. Robinhood, it's as free as you can get. That's kind of their shtick, and their app and website are super user friendly. But I would not recommend investing through Robinhood with your main chunk of money. They do not have automatic reinvestment or DRIP, so you're not able to buy partial shares and really take full advantage of the compound growth. So that would be, if you have a little extra, what I would call quote unquote play money to set aside, $100 here or there, that's what I would use Robinhood for. But again, going with, in my case, Schwab, the main thing I would default to is buying index funds, specifically Vanguard index funds, which probably most any person that you may research will probably tell you. Vanguard is excellent in terms of low expense ratio, tracking the market, which if you look at a line is just constantly going up over time. So Vanguard index funds are a great choice in my opinion. Going back to Robinhood, another cool feature of it is that you can earn up to $500 in free shares through signing up. First yourself, and then through signing up your friends, family, etc. You give them a link, they click through it, they install Robinhood. Both of you get a free app. So I'll put my own link in the bottom of this video. If you haven't yet signed up for Robinhood, both you and I will get a free stock share. So basically that's it, guys. Thanks for your time. Hopefully you found this video informative. I know this channel is new, so it'd really help me out if you found this video informative to hit the like or subscribe button below. But in any case, thank you for watching and have a good one.